Welcome back. If you've been listening to this series from the beginning, this episode is going to feel like a synthesis, a bringing together of everything we've covered into one cohesive investment case. If you're new to the series, this is the episode I'd recommend starting with, and then going back to the earlier episodes for the detailed context that supports each point. Either way, let's get into it. The aviation infrastructure investment thesis rests on three structural truths that, when combined, create a uniquely compelling opportunity. First, demand is large and growing, driven by a decade of record aircraft deliveries, a permanent structural expansion of the private aviation user base, and the upmarket composition shift of the fleet toward large cabin and ultra-long range jets. Second, supply is constrained and cannot respond quickly due to regulatory complexity, airport land scarcity, and the comprehensive physical obsolescence of the legacy hangar stock. Third, barriers to competitive entry are among the highest in commercial real estate, protecting first-mover investors from meaningful competitive pressure over any investment timeline relevant to a fund vehicle. On the demand side, the numbers speak clearly. 8,700 new business jets worth $277 billion over the next 10 years. A global business jet market growing at nearly 9% annually from $37.6 billion today to over $81 billion by 2034. Business jet utilization up 14 to 22% since 2020. Long-range jet demand up 28%. Every metric points to the same direction. More aircraft, flying more, operated by a larger and wealthier customer base, generating more demand for the infrastructure to service them. On the supply side, the constraints are equally clear. Nearly half of the existing U.S. hangar inventory is functionally obsolete for modern large cabin jets. A new hangar development takes 3 to 5 years from concept to completion, moving through FAA airspace reviews, NEPA environmental assessments, airport authority lease negotiations, municipal permitting, and NFPA 409 compliant construction. Airport land is a genuinely fixed resource. No new land can be added to an established airport's footprint without multi-year federal approvals. The supply deficit is not a problem that resolves on any timeline that's relevant to a 10-year fund. On the financial mechanics, hangar fees rising 11 to 19% annually at major hubs. MRO revenue growing at 4+% annually in a market heading toward $155 billion globally. FBO fuel margins that benefit from the combination of inelastic demand and supply-constrained locations. Ground lease terms of 20 to 40 years providing durable, protected occupancy. The financial characteristics of this asset class, stable base yield, variable upside, non-discretionary contractual revenue, inflation linkage, and platform premium at exit, add up to a return profile that is genuinely difficult to replicate in conventional alternatives. On the institutional validation, Apollo, Bain Capital, KKR, Global Infrastructure Partners, Carlyle, Ares Management, the most sophisticated capital allocators in the world have entered this space and are actively growing their positions. That validation is not just confirmation of the thesis, it's also the roadmap for the exit. When a well-assembled middle market aviation infrastructure platform comes to market 5 to 7 years from now, the institutional buyers for it are already identified and actively expanding. You know who they are, you know what they pay, and you know what characteristics they're looking for. That exit visibility is unusually clear for an emerging asset class. And on market selection, Dallas-Fort Worth and Orlando represent two of the most compelling markets in the country for aviation infrastructure investment. DFW for the depth and diversity of its corporate demand, the scale of the supply gap, and the extraordinary economic momentum of North Texas. Orlando for the genuine diversification across defense, tourism, technology, and healthcare demand, the development opportunity at secondary airports with available land, and the Florida regulatory and tax environment that supports rapid capital deployment and operational efficiency. Paired as a dual market strategy, they offer geographic diversification, economic sector diversification, and complementary risk profiles that strengthen the overall portfolio thesis. That's the complete investment case. It's grounded in data. It's validated by institutional action, and it's investable right now in real markets through a well-structured fund vehicle. That's what Pentagonal Aviation Infrastructure is building towards.